Everyone wants the magic settings to print money with a trading bot, but here's the truth. Copying my settings won't get you far without understanding the actual structure behind them. So in this video, I'm going to show you what's actually running the show, why the engine matters more than the settings, and what that means for your long-term survivability as a trader. And stay with me until the end because I'm going to reveal the one thing almost nobody talks about, the hidden lever that separates consistent traders from absolutely everyone else. And once you see it, you're going to understand exactly why my results look the way they do. So every single week, I see the same scenario play out. A trader just copies someone else's settings, same indicators, same triggers, same multipliers, and they assume the results are going to match. But inevitably, a few days later, the market pulls back, volatility spikes, and suddenly they're staring at a position that they don't understand, a drawdown that they can't control, and even a liquidation line sitting far too close for comfort. They copied the inputs, but not the infrastructure behind them. And that's the actual problem because settings, they're just coordinates, and coordinates without a guidance system don't tell you anything about where you are, whether the path is safe or how the environment might actually change. Traders assume settings equals outcome, but two traders can run the exact same inputs and get completely different results simply because they're not using the same structure. This is the flaw that almost everybody misses. Settings don't assess volatility, understand trend length, detect compression, or respond dynamically to any kind of liquidity. So when the market behaves unpredictably, and it always will, a system built on settings becomes fragile. Fragility is why people blow up, not direction, not entries, and not timing. Fragility kills trading systems more reliably than being wrong about our direction does. So let me just give you the simplest way to think about this. Settings, they're coordinates, and for us, we need a GPS because coordinates tell you where you want to go. And for us, we use the power law as our system because that tells us where we actually are, how far we can safely move, and how much risk the terrain can support. Without the GPS, the power law in our case, the coordinates are going to lead us absolutely nowhere. So with the power law as our GPS, the coordinates are going to finally make sense. So even if you're just imagining it, this is going to click. Imagine two charts side by side. Chart A, someone running aggressive settings with no reference to market structure. And chart B is someone running the same settings, but the system sizes positions according to the power law. Both traders enter at the same time and both run the exact same bot, but immediately the behavior diverges. On chart A, the liquidation line rises fast. On chart B, it sits comfortably below danger. Same settings, different survivability. This is where traders realize, okay, it's not the settings, it's actually the architecture. And once you understand that structure matters more than settings, the next piece becomes obvious. The part of the system that keeps you alive isn't the entry, it's actually the size. So position sizing is the mechanism that determines how deep you can go into a safety range, how much downside that your bot and your algorithm can absorb, and where your liquidation level sits relative to reality. This is the difference between a system that can withstand volatility and one that simply collapses the moment conditions change. So let's break this down with a clear and simple walkthrough. So scenario one, we have incorrect sizing. Trader A runs a bot on, let's say, 3x leverage using 80 to 90% of their capital because they want maximum gains. But this does three things immediately. Their liquidation line is going to rise aggressively, their margin of safety is going to shrink to almost zero, and a normal 5 to 10% move is going to become absolutely catastrophic. So when an asset like Bitcoin is going to pull back, as it always does, their entire system collapses. Not because the settings were bad, and not because the entry was wrong, because the position sizing was much too fragile. So let's take a look at scenario two, the correct sizing. Trader B is going to use a fraction of their capital per entry and is going to size their position according to the power law deviations. This means they're going to have more breathing room, lower liquidation, and drawdowns that are absolutely survivable. Volatility that doesn't threaten their account, and plenty of the space for the algorithm and the bot to do its job. The result? Same settings, same market, two entirely different outcomes. Trader A gets liquidated, Trader B is still alive and compounding over time. And this is that part that almost no one talks about. If you survive long enough, compounding is just going to take care of the rest. If you don't, nothing else matters. So watching a bot win 30 trades in a row means nothing if number 31 ends your account. I like saying that 100% of nothing is still absolutely nothing. So survival is a strategy, position sizing is survival, and the power law makes survival predictable. So if you want to understand this at the level where it becomes usable, not theory, not hope, but actual execution, book a call using one of the links below. You'll see why traders, funds, and even people inside the industry come to Minotaur Trading Systems. I've spoken on the Binance stage, and we work directly with Giovanni Santastasi, the physicist behind the power law model itself. We've taken those principles and built a system that sizes positions dynamically, adapts to volatility automatically, and aligns every decision with Bitcoin's long-term power law trajectory. This is not about chasing settings. It's about running a system built on solid mathematical foundations. Book the call and we'll talk you through how the architecture works, how the power law acts as our GPS, and how to structure your position sizing so your system is durable, not fragile. And once you've done that, watch the YouTube video linked here, the breakdown of the $1.2 million position my system managed during the recent Bitcoin crash. You'll see exactly how proper position sizing and power law structure protected the position while thousands of traders were being liquidated around it. And that's a video that you can watch next.